want to start the session by you all answering the question that is visible to you on the screen. That what does investing in stock market mean to you? Whatever comes to your mind, especially the new guys. If you feel stock market is like a gamble, you're scared, it's fear or avenue to create wealth, whatever comes to your mind first, instantly, just type one word, two words, sentence, whatever comes to us. Just type it.
It's a risky game, like what we do in IPL. We put money for some team, and then
If you don't mind, can you type into the chat box? Yeah. So let me set the ground rules for the session that I would be the only person talking till the Q&A session. And the mode of interaction for either of us, like you can ask me any questions or you can respond to the questions through the chat window so that the flow of the session is not interrupted. Any of your questions, you can post into the chat window. If I feel it is appropriate to answer me at that point itself, I will answer it immediately. If I feel it would be better, I take it at the end. What you can do is you can just keep it parked, and at the end during the Q&A session, you can again ask me back. Is it fine? Am I clear to all? Okay, thanks. Ready to go. Arun says stock market is a secondary source of income. Gopeshwar says investing money based on market trend. So that means he's more about trading. Anita says money is there. No doubt, Anita. Lot of money is there. Sashank says participate in a business which I'm not able to run. Very true, Sashank. Rightly said. Harsh, higher returns. Again, right. Stock market, I think equities to be more precise, had been the highest earning investment option over the last 6 decades. Abhishek says risk, no doubt. In fact, to that fact, risk is there in almost every investment. What is the risk involved? That we need to learn. Sandeep says a best source to multiply our savings. Rightly said. Kuldeep, risky and excited game which needs your involvement, kind of betting. Yeah, Kuldeep, it all depends. What's your role into the stock market? Like, are you playing? There are 3 different roles in the stock market. So I will deal with that during the session. And then you will understand that whether you are in a proper path or you need to just change the course. So let's start. For me, stock market is a gold mine. This is what my view of stock market is. That stock market is a gold mine. And gold is not readily available. Am I right? How many of you have know about how easy or difficult it is about mining gold? It's one of the most toughest operations, mining gold. So you need to put a lot of efforts to mine the gold. Yes, no doubt there are certain risks involved. You have to take certain caution measures to mine the gold. But ultimately, you know that your efforts are going to pay and you will become wealthy. Now, what makes me to say this? See, this is how Sensex has moved in the last 30 years from Jan to Jan. Jan 21, I have not kept it consciously. So if you see, take out any period of 5 years or 10 years, and you will see Sensex has never been negative. Whether you say 90 to 95 or 91 to 96, or you say 2001 to 2006, or even 2009 if you say, and stock market crash, and if you go to 2004, still market is positive. You remember 2009 horrible crash. Still market is positive. So market, if you see stock market, you take any 5 years period, it has never ever given a negative return till date. So what first thing that comes out of this picture is stock market is actually a long-term game. So your risk becomes zero or negligible. To be precise, your risk becomes less than 0.5% if you stay invested into a market for more than 5 years. And see where we are today. And that's what we want to know, that we're at all-time high, 60,839 to be precise, today's almost closing because the screenshot is at 3:15, just before the closing. And if you see the trend, market for a long term has always gone up. It has always gone up. There may be dips, but ultimately there is only one way in a long term where the market is headed to, and that is up. And no doubt about it. Does anyone has a doubt about this? That in a long term, stock market goes up? Does any one of you have a doubt that in a long term, will the stock market go up or not? Even after seeing these numbers, and these numbers are all facts. I'm not telling any story. I'm not giving you anything. Okay, no one responds. So I mean, no one has any doubt. So that is what I infer from it. But still, people lose money in the stock market. Do you know that 99%, yes, I mean 99% of the people who enter into the stock market ultimately lose money? How many of you agree with me? If you agree, type yes. If you don't agree, type no. 99% of the people who enter into the stock market ultimately lose money. And only 1% really make long-term wealth. And the reason why they don't make money, in spite of market being giving such a positive opportunity, stock market giving such a positive opportunity, in spite of that, why do people lose money? And what we need to do at the current market level? Rahul says, no, I guess this has changed. Rahul, if you are considering the last 2 years experience, then that is not long term. Because I've seen people making riches in short term, making jackpots in short term, but then going pauper. So creating wealth is one of the easiest tasks. Maintaining wealth is the real challenge. I will take up a session on this, maintaining a wealth, the art of maintaining a wealth. Thanks, Rahul, you have given me an idea for a yet another session. So surely I will take a session on the art of how to maintain wealth. Okay. So Rahul, if you are saying this just because of the last 2 years experience, then this kind of 2 years experience has always been there, but the numbers unfortunately have not changed. So I see people into the stock market for
Rajesh,
5 years period.
yeah, Rajesh, this is Rahul here. So why I'm saying this because I have seen investors getting more knowledgeable. They are more patient. Like I have been in stock market for around 8.5 years now.
Yeah.
And I have seen there is a drastic change in perception and the patience, the awareness which common citizens is having. And definitely technology has improved a lot. Like 8 years, 9 years back, I remember trading was a little bit different. Today it is seamless. Options have increased a lot. Mutual funds have increased. There is a direct concept of direct mutual funds. So overall, I say that no, 99% is might be a little too harsh. Probably still like the percentage is growing now. People who are making some wealth.
Acha, Rahul, one clarity. When I'm saying 99%, these are the people who are directly investing into the stock market, and I'm not speaking about mutual fund investors.
Oh, my bad. I was assuming both stock market through mutual funds.
Sure, people who are stock market investors, that is what I'm talking about. Okay. And stock market, unfortunately, has not changed. And this brings us to yet another point. Good point raised, Rahul, because this was the next thing that what are the ways to enter into the stock market? There are two ways. Mutual funds is the one primary and easiest way. Second is direct entry into the stock market. That is, you open a demat account and you trade into the stock market. And today, the session is all about direct investing into the stock market. Mutual funds, we have a session in November the date would be notified by Lakshmi very soon. Lakshmi, what is the date? Can you post it in the chat window for the mutual fund session? So mutual funds, we have got another session. Yeah. So today we'll be talking about only direct entry into the stock market. And why people lose money into the stock market is most of the people end up picking either a wrong stock into the sense wrong company. If they even pick up a right stock, they pick up stock at a wrong price, or they enter into the market at the wrong time. So either of the three reasons, people lose money into the stock market. And then the question would be, Rajesh, how to pick up a right stock? How can I pick up a right price? How can I know that whether the timing to invest into the market is right? Now, when I say timing is not just about entry time, but timing of how long you stay, that is also important. Now, what is the right way? What is the right way of getting into the stock market is, there are two knowledge streams, or two approaches. One is called fundamental, another is called technical. Now, fundamental, how it picks up right stock is, a fundamental analyst will always identify a company with strong financial background. They will see the balance sheet, P&L, they will see the future growth prospect of that company, and they will pick up companies with a strong financial background. And technical analysts, what they do is they identify the current trend, that how the price volume movement in the market is happening, irrespective of the company fundamentals, whether it is positive, negative, strong, nothing to do with the fundamental. They will only see how people are perceiving about that company, and based on that, they will identify the trend. Now, pricing. Now, pricing, fundamental analysts will look at the valuation, whether the current company is available at a right price or not. Like how you go. See, when you go to market and try to buy anything, the vendor say it is at 100 rupees. Say, I'm just planning to buy this bottle. Okay. I'm just planning to buy this bottle. Now, the vendor for this bottle says, sir, it is at 500 rupees. Now, what is the first question that will come to mind? Is this bottle worth for 500 or not? Isn't it? Isn't this the first question that comes to our mind? But how many of us, when we go to the stock market and want to buy a share of a company, really think that whether the share price of that company is justified or not? Hardly anyone. And that is where I'm talking about. 99% of the people don't even think of that. They are only saying कि boss, आज 100 रुपए का है, कल 200 बनेगा, आज 200 का है, कल 400 बनेगा. That's the only thing. They don't know why it is at 200. They don't even know why it will go to 400. Parallelly, technical analysts, what they do is they try to identify crucial supports and resistance. Now, these terms are slightly technical. Support and resistance. They are slightly technical in nature. So people who are new to the stock market, I will just take you through that. If you see any stock market price movement, how it moves like this, isn't it? It always moves like your heartbeat. So all the top, when it goes up, comes down, goes up, comes down, all the top, when they are connected, it becomes a resistance. Resistance means when the price of a stock is going up, there is a resistance which is not allowing it to go over and above it. So that is a resistance, that the stock will go up to this price and then it may not go up. Similarly, when something is falling down, like the price is falling down, after a level, it goes to a level and then bounces back. So when this is identified, this is called support. Now, if you want to learn this, you have to do a technical analysis class, but this is what support and resistance means, and this is how technical analysts try to identify where is the support, where is the resistance, and based on that they create their own trading plans. And then right timing means through evaluation of future growth. So fundamental analysts, what they do is they don't just see the present of a company, that currently whether the company is doing good. What they also see is in future also, is this company expected to do good or not? and whether at the current valuations, is this entry justified or not. This is how they look. And technical, they point their entries and exits based on the supports and resistance that they have identified. The question is that if you want to mine the gold mine called stock market, you need to do either fundamental analysis or technical analysis. Now, tell me, you say, Rajesh, मेरे पास time नहीं है. I don't have the time neither to do fundamental analysis, neither to do technical analysis. So if you don't do take fundamental analysis, neither you are aware of technical analysis, that means surely you're trying to go and mine the gold without any proper strategy, proper plan, proper skills. So do you think you can actually go and mine the gold without a plan, without a strategy, without acquiring a proper skills? Do you think you can? Harsh says no, Mana says not possible. Abhishek says no. Anshul says no. Rightly said. See, if I have to buy a car, what I need? I just need money, go to the car showroom, buy the car. But just because I bought a car, since I have money, with my money I bought the car, can I drive the car? No. What I need to learn driving, isn't it? And what will happen if you drive the car without learning the driving? Accident. And that is what the risk is. Similarly, in the stock market, the risk is not in stock market. The risk is not knowing what to do, how to do, and when to do in stock market. Am I clear? Am I able to drive the point home? Are you guys able to get? Because what I have seen is post-pandemic, many people just went, open a demat account, because now it's very easy. There are a lot of online apps. At the luxury of your home, you can go and open a demat account. They just invest 10,000, 20,000, 40,000, 1 lakh, whatever they can do, and start trading into the stock market without having any knowledge, any skill, anything. Nothing wrong, boss. It's your own money. It's your own money. You can either burn your money into the stock market. If you have a well, because nowadays we don't find well, but if you can go and find some well easily, you can throw that money into the well, because at the end of the day, your own money. I have no right to say anything. But only thing that hurts me is this money hard-earned money? या कैसे चोरी करके लेके आए? Is the money which you are investing into the stock market, is it a hard-earned money or an easy money? I'm awaiting for the responses. Is it a hard-earned money or an easy money? The money that you would be investing into the stock market, is it hard-earned money or easy money? Now, when it is hard-earned money, do you think it is just to put your money into the stock market without learning it? Or should you be doing some hard work to ensure that your hard-earned money is put to proper use? And ultimately, you can create wealth for yourself and your kids. What do you think would be a better option? Yes, no doubt. We should learn and earn and put it in a proper way. So whether it is stock market, whether it is real estate, whether it is mutual funds, you put money in anything except for fixed deposits. Okay, because fixed deposits, you don't earn money. Fixed deposits, you only maintain your money, hardly any return. So except for fixed deposit, no doubt wherever you put your money into, you should make certain hard work to learn about what, why, and how you are investing into. So basically, the first thing, how you need to plan your entry into the stock market. So how you should plan your entry into the stock market is, first, choose your style. Choose whether you want to be an investor, whether you want to be a trader, and don't say both. No one can be both. Either you can be an investor or you can be a trader at any given point. Earlier I was investor, now I'm a trader. Earlier I was a trader, now I'm an investor. That can always happen. Like Rakesh Junjunwala, he was earlier a trader, now he's a value investor. So this thing can always happen. And then once you choose your trading style, understanding how you can pick up a right stock by fundamental analysis or technical analysis or combining both. Then evaluating a stock, defining your entry points, and ultimately managing the risk. How are the steps involved? I will tell you in brief, because this itself is a big thing to learn. So I will just tell you in brief how you can pick this up. Now let's see what are the type of players into the stock market. There are three kind of players into the stock market: a trader, an investor, and a gambler. Now you may say, Rajesh, what is the difference? A trader, a gambler, both are same, isn't it? Do you think they are same? See, basically a trader does a technical research. He does some calculations and takes calculated risk. They do take high risk, but they take calculated risk. And they are into serious business. They're not part-timers, like full-timers into the stock market. Or even someone is doing part-time, they invest a lot of their time, effort, and energy into the stock market. So traders are basically take this as a serious business. And investors, for them, this is not a business. They do whatever they do. Like I'm an investor. I don't see stock market throughout the day. Just at the end of the day, after I go home or something, then I open my mobile app and just see what has happened the stock market today and what is the variation in my portfolio. That's the only thing I look on stock market screen in throughout the day. That's it. At the end of the day, I do that. How many trades I do in a day? In fact, I just do 4 to 5 trades, max 8 to 10, not in a day. I'm speaking about an entire year. Yes, in a year, just 8 to 10 transactions max, not more than that. So I don't spend much. Most of my time goes into identifying the stocks, reviewing my existing investments, learning about the companies, learning about their business models. That where most of my time goes into. And then a gambler, what does he do? Boss opens a trading account. राजेश ने बोला आईटीसी में इन्वेस्ट कर दो, अतुल ने बोला रिलायंस में इन्वेस्ट कर दो, someone else said invest in some Allaya Pullaya company. You don't know what that Allaya Pullaya company does, you don't know what that Allaya Pullaya company is, but said boss it was 500, today it is 1000, and short tip it is going to go to 2000. And investing, is it really investing or is it just going and buying a lottery ticket? Tell me, if you invest into a company or trade into a company which you're not even aware of what business it does, how business it is, what is the history of the company, you don't know anything about that company, you only know the name and the stock market price, and a tip has come that it was X, today it is Y, and tomorrow it will be Z. So in anticipation of it moving from Y to Z, you have invested or you have put your money into that company. Tell me, is it trading, is it investing, or is it actually gambling? Only Satyam is clear what it is. The rest all I think are still thinking whether it is trading, investing, or gambling. And this is exactly what 99% of the people do into the stock market. And I thank you guys, acknowledge you guys that by attending this session today, somewhere you are showing the seriousness that yes, you guys are willing to learn, are willing to know about the stock market before you even put your money into it. So you need to pat your back and just don't end with this session. This should just be a beginning. This should just be a beginning. And then you should start learning about stock market seriously if you really want to put your money into the stock market. Else, boss, put your money into mutual funds, take a peaceful sleep. Don't unnecessarily buy stress by putting your hard-earned money. So this question is basically for experienced people. Since all of you are new, most of you are new, I would skip this question. So let's come to the straightway point that how do I shortlist my stocks? What you're seeing on the screen is just a 15 minutes mantra. A 15 minutes mantra that within 15 minutes, you can review a company and decide whether it's even worth spending your time, money, and energy to invest into it or not. How many of you are really interested to learn this? Just 15 minutes, and you can decide whether this company is worth considering or not. So, people who are interested, first, I would like to know how many of you want to be an investor, how many of you want to be a trader, and how many of you are still willing to risk your money by being a gambler. Because accordingly, I will spend my time and energy into this session because we have got limited time. So whether I should focus on the investing side or trading side. Nice to see everyone saying investor. So I would be focusing more on investing side and I would touch base a little on trading side. Don't worry, I will not disappoint people who want to be trader, but a little on trading side. Mana says 20% trading, 80% investment. Okay, Mana, I will even tell you how you can try to do both. But I advise always never to do both. But still, if you want to do both, I will still tell you how you can try doing both. I have tried, I have failed, but I can still say you how you can try. Okay. So there is a site called screener.in. How many of you have heard about it? Screener.in. Good. So people who are hearing for the first time, please make note of it. And the first thing that you do immediately after the session is go log into screener.in and open your account into Screener. It's a free website. They have got a premium version also, but you need not go for the premium version. Go for the free website. Now, how to use the Screener and review a company in just 10 to 15 minutes in Screener. Now tell me one company. So whatever first company name I get, I will review that. One company in stock market. ITC comes first. ITC, Royal Enfield. Royal Enfield is not the company, it is Eicher Motors. Tata Elxsi, SBI, Infosys, Indian Oil, Tata Motors, Tata Power, Wipro, SJVN, HDFC, DLF. So I would pick up ITC, Royal Enfield, that is Eicher Motors, and TCS. These are the three companies that I would pick up. The first three that I got. So let's see ITC. So ITC Limited, if you type, you will get it. So this is how your screener would be there. Now, these are not the default things. You have to add ratio here. Like here, you can go to edit ratios and add certain ratios. Now I will tell you what are the ratios that you should look into the screener. So what you need to look at is first, any company, what is more important? The top line, that is the sales, and the bottom line, that is the profit, isn't it? Like kamata kitna hai, that is how much they are earning. Bachata kitna, what is the net profit, isn't it? That is the topmost thing that you need to look at any company. So what you look at is what is the last 5 and 10 years average sales growth and profit growth. And what you will be looking whether it is greater than 10% or not. That is the first yardstick. Second is there is something called return on equity and return on capital employed. Now you will ask, Rajesh, what is return on equity? Now return on equity is the shareholders' money. So people who are buying shares of a company, that is if you buy say shares of ITC, you will become the shareholder of ITC. So the company is owned by the shareholders. So shareholder ka jo paisa hota hai, shareholders' money is called equity. Now, if I have invested money into a land, say 1 lakh rupees, on that 1 lakh I've got 10 100,000 rupees as my earning in 1 year. What is my return? It is 10%. Similarly, the money which has been invested into the company, not through stock market, but actual money that has been invested into the company for the business purpose, on that equity, how much return the company is earning. That is a return on equity. And capital employed is company not only do business with its own money, it also gets money from other sources. What are the other sources? Tell me. Other than the shareholders, that is the promoters or the owners' money, what are the other sources? IPO is again shareholders' money only. Boss. Yes, debt and loan. Debt, basically debt or loan. So say a company has taken 50 crores from investors or shareholders and taken 100 crores loan. So on this 50 crores, what is the return that the company has generated becomes return on equity. And this 50 plus 100, that is 150 crores, that is the total capital that has been put into the company. The return that is generated on this 150 crores become capital employed. So what we normally look at is the 5 years average return on equity and return on capital employed should be more than 20%. All right. Then this comes to the next ratio, debt versus equity. So what I said, I have taken 100 crores loan and shareholders wealth is 50 crores. That is 50 crores equity and 100 crores debt. Now what will become debt to equity ratio? That is 100 divided by 50. It will become 2, isn't it? But is it good doing business with more debt, or is it good doing business with your own money? What do you say? Anshul says debt. I think he is on opium. You guys know opium? Opium, I'm done. वो चरस गांजा वाला opium की बात नहीं कर रहा हूँ. I'm speaking about the abbreviation OPM. They say other people money. Okay. So when you're doing your own business, it is good to use other people money. But when you're investing into a company, it is always better that the company does business with its own money. Because what happens is if the company has a lot of debt on it and say situation like COVID comes, what happens? The company will collapse. Isn't it? So it is always better to invest with low debt. And what is the preferred ratio is less than 1. That is, if the company has 50 crores of its own, the max that it should have taken from as a loans should be another 50 crores. That is less than 1 or max 1. Then there is something called interest coverage ratio. Now, interest coverage ratio in short means how many times of interest, because if I have taken loan, Prem, you are raising hand. Is it by a chance, or if you have any doubt, you can just type it into the chat window. Yeah. So interest coverage ratio is if the company is taking, let's say 100 crores loan, it has to pay interest. Now if 100 crores, if I have taken at 8%, it becomes how much? At 8% of 100 crores, it becomes 8 crores. Now if I am paying 8, if I have to pay 8 crores, I need to earn more than 8 crores. Am I right? So how many times of the interest that has to be paid the company is earning? So if I'm paying 8 crores, I need to earn at least 24 crores. That is 3 times, minimum 3 times of my interest expenses. That is what interest coverage ratio is. Then current ratio. Current ratio means the current assets divided by current liability. So current asset or current liability definition is any asset. Asset means which is owned by me. Liability is which I'm owing to others. Which I need to pay to others. So my current asset versus current liability should be 2 times. That is, my current asset should be double than my current liabilities. So I cannot tell these things in depth because we have paucity of time, but I'm just touching boss. Then free cash flow. Free cash flow is something called what is the net cash income. Now say company has done 100 crores sale. Now on 100 crores, I have made 10 crores profit. So my net profit is how much? 10 crores. But on 100 crores, I actually got cash only 50 crores and rest 50 crores is debt. That is, people said it's given on credit. They will say they will pay me later. And I have paid actually this year, outflow is 60 crores. So what is my net cash flow? inflow is 50 crores, outflow is 60. What is my net cash flow? Minus 10 crores. Though my profit is 10 crores, my cash flow is negative. So what will happen? Though you have profits, but the profit is not with you. The profit is there with other people. And you are there with negative cash flow. So it is like you are joining a company. The company says, I will pay you 1 lakh salary per month, but only 50,000 I will pay you now. Rest 50,000 I will pay you after 3 years. And your monthly expenses is 80,000 per month. What will happen? What will happen to your cash budget? You will be always minus 30 every month, because the 50,000 which you should receive is still with your company, isn't it? So cash in hand is always better. So not just profit, we also look at what is the free cash flow of a company, whether it is positive or not. And last but not the least is the PEG ratio. PEG ratio is PE divided by growth. So it is a yardstick where you can match. Now, what is PE and PEG ratio? I will take it to you on screener. Now, these are the basic ratios. Now, take a screenshot of it and try to learn what are these ratios if you are really interested on your own, or you can join some course, or you can just blindly try to see that what are these ratios and how you should look to it on screener. Now, here it is. Now, ITC, what was the first thing that we were looking at? Sales growth in last 5 years. So sales growth of ITC in last 5 years is only how much? 5%. ITC has grown only by 5%. Now, what is my profit in last 5 years? Profit variance in last 5 years? Only 7%. And what we said, we basically try to look at companies where the sales and profit growth is more than 10%. So this company, ITC, though it's a very good company, in the last 5 years, can you see it is hardly growing? It has got stagnated, isn't it? Now, would you like to invest into a company which is really growing fast? Or would you like to invest into a company which grew fast earlier, but today it is stagnated? Today it is not able to grow. What you will invest into? It's a choice to be made. Next, what I said, return on equity. So return on equity, if you see last 5 years, it is 22.8%. And return on capital employed, that is ROCE. Now, how to add this ratio? If you click edit ratio, here it will be like ROE, return on equity. So return on equity preceding year, I am just adding this. Okay, say quick ratio, it will get automatically added. So this is how you can create your own dashboard into screener. So you can add these ratios by searching it by edit ratios and searching for it. Then return on equity, return on capital employed. If you see this yardstick, it is really doing great. It is giving you ROE for last 5 years and ROC for the last 5 years more than 20%. So it's a good that it is whatever capital is there with the company, that it is managing really good. What was the next thing that we were looking at? PEG was the last, Sudarshan. Debt to equity. Now debt to equity is 0. The company is having hardly any debt. It's a debt-free company. All shareholders' money. And after debt to equity, what we are looking at is interest coverage ratio. So when there is no debt, there is no point in looking at interest coverage ratio, which is like 500 times, because it is hardly a negligible debt. Well, they would have taken some bank OD or something, that is what is reflecting as a debt. Now next, debt to equity and interest coverage ratio. What is the thing that we look at? Current ratio. So current ratio should be more than 2. Here it is almost closer to 2. Almost closer to 2. And last but not the least, what we were looking at is PEG ratio. Now, PEG ratio is a combination of stock PE. PE means if the company is earning, say like ITC current price is how much? 245. And what is the EPS it has earned? That is earning per share. Like per share, how much? Like every share. Like if I am having 100 shares, every share of mine, how much rupee profit it has earned in that particular in last year? That is 11 rupees. So this 245 divided by 11 would be 21.6. 21. That is 21 times of my current year earning is what the stock price is. This is the price to equity ratio. Now PE divided by sales growth becomes my PEG ratio. So PEG says what is the valuation of the company plus how the company is growing. So basically any company with a less than 1, near to 1, really good in terms of valuation. So this indication indicates whether the valuation of the company is really good or not. So these are basically the key points that you look into any company. Now, yes, positive cash flow. Here it is, FCF, free cash flow, previous year. So here it is the free cash flow, Sandeep. 12,276 crores is the free cash flow. Now, in the screener itself, this is only the dashboard. What all things are available into the screener? See, here it is. You will get the price movement in the last 5 years or max years. You will get PE ratio movement, how the PE ratio of the company is. And then peer comparison, your last 12 quarterly results. So you can see how the quarterly results have been. You can also even open the stock exchange. What is the declaration? If you click here, it will open profit and loss for the last 12 years. So you can compare. See, in 2010, company was earning 19,127 crores, and today it is earning 52,746 crores. So you can see how the company is growing. And if you see, from 2010 to 2015, the company grew drastically, and from 2015 onwards, the company is on a very slow growth. It's quite visible, isn't it? Similarly, if you see the profit before tax or your net profit, if you see from 4,168 crores, it came up to almost 10,000 crores. And from there, it has almost stagnated. It became 2.5 times, and then it becomes stagnated. It is hardly growing. It's growing at a very slow pace. Similarly, with your EPS, that is earning per share, that is per share, what is your earning? This is the balance sheet, which you can see. Then the cash flows. Here is the cash flow. If you see the net cash flow, how the net cash flow is, whether it is negative or positive. The ratios, the shareholding pattern, that how much FIs are invested, how much domestic institutional investors are invested, and how much public has invested. You can also get the annual report of the company by clicking this button. You can download. You can also go for the credit rating report, which also gives you a lot of insight into that, what business the company is into and how the credit rating agency anticipate the company's future. So these are the two documents. If you're interested in a company, annual report and credit rating report, these are the two documents which you should download and read about that company. So this is how you can actually start exploring. As per PEG ratio, it is overvalued. It is overvalued because the company is hardly growing. So you don't just pay about the current fundamental of the company. Currently, fundamentally, the company is really good, but the growth of the company is stagnated. So you don't just pay for the current valuation of the company, you also see what is the future growth of the company. So whether the future company growth is great or not. So what you should actually basically do when it comes to fundamental analysis, what you should be doing is do the initial fundamental screening, which will take you just 10 to 15 minutes. Am I right? MP, I didn't spoke about. I said ITC is overvalued as per the PEG ratio. Yeah, Kuldeep. As per the, see, if you see, except for sale, except for the growth, rest all parameters, ITC is really good. So ITC fundamentally, it's a very good company. It's a very good company. But is the company growing? And one should always remember, Kuldeep, tell me, when you're buying a share of the company, are you buying for the current valuation of the company? Are you buying for the future of the company? But anticipating that the company's future would be good. Future? Yeah. Now, what is going to determine the company's future? Is it the current financial strength or its growth history and growth prospect, that in future, whether it is expected to grow or not? Its future growth projection. And ITC, currently, the way it is going, it is hardly expected to grow leaps and bounds. So in stock market, when you have got multiple options, I'm not saying ITC is bad, ITC is good. But would you like to invest into ITC, which is good, or would you like to invest something else which is better than this? Because at the end of the day, in stock market, opportunities are more, but the resource that you have is limited. So when you have limited resources, would you like to put your bet into the best thing or something that is good? So if you don't want to take much risk, very growth, okay, boss, company is doing good, every year it will give me dividend, not much growth, fine it is, it will give me a return better than my fixed deposit return, then yes, stocks like ITC are really good. But if you are investing into the stock market that 10 years, 15 years, you should get 2x, 3x, 4x kind of returns, then stocks like ITC are not good. So it is about what is your objective. And this is where once you learn fundamental analysis, you will be able to appreciate these aspects more better. Even if you don't have a time to go and join a fundamental analysis course or anything, I'll just tell you that how you can start spending some time every day and start learning. Now, how you can learn about the company? So, Kuldeep, if you're really interested in ITC, what you should be doing? We have done the fundamental screening. We saw that company's current valuation, like fundamental wise, company is good. Growth, I have got a question mark because I'm only seeing past 5 years growth. I don't know how next 5 years growth is going to be, isn't it? Now, how should I try to look into next 5 years growth? What I should do? Download the credit rating report, download the annual report, and go through the credit rating report and annual report of that company. Go through it. There is a document called management discussion and analysis in annual report. I repeat, in short, it is called MDA, and the doc is called management discussion and analysis. By the way, I had been a company secretary and I have drafted more than 25 annual reports of a listed company. So I know how annual reports are made and I know how annual reports are actually read into. And yeah, so you should read management discussion analysis portion of that annual report. So whichever company you want to explore, you should actually go to the company's website, download the annual report, or come from screener, you can download the annual report, go through the annual report once and understand the business model, understand which business the company is into. Like ITC, it is into multiple businesses. ITC is into FMCG, ITC is into tobacco, ITC is into hotels, ITC is into paper. Am I right? It is into multiple businesses. So understand the business model of that company and try to see which business it is making money, which business it is losing money, and which business has got a good future. Like ITC, tobacco business, very good future. No doubt. No matter what the cost may be, people are not going to quit smoking because cigarette in my hand, I feel like a man, isn't it? What about the other businesses? Paper, is it post-COVID, is it doing really good? No. FMCG, post-COVID, is it doing really great? Third, it's hotels, is it really doing great? No. So then you need to look at, weigh it down and then take your own call that whether you feel ITC has got a good future or not. So if you want to invest into this company, do this analysis, see if you really are able to understand, if you see great future into this company, then you can invest. And if you're a trader, then I would say do the technical screening and do a detailed analysis. But for traders, people who are traders, not traders. Now, people who are traders, what you should be looking into? So you should be looking into technical analysis. You should learn technical analysis. Technical analysis is what is. It's actually a science of price and volume action. That how the price is moving, and along with the price, how is the underlying volume? That is how many shares are, how many thousand, how many lakh shares are traded per day. How that volume is increasing and how the price is behaving. So based on price and volume movement, there's a trend that emerges. So in technical analysis, people try to look at the trend, and based on the trend is ascertained in three ways. Bullish, that is, it is expected to continuously go up. Bull, what it does? It actually, why it says bullish? Basically bullish, when it says bull, when the things are moving up, why it says bullish? Bull, when it hits someone, it actually knock it from your horn and throw that guy up, isn't it? So when something goes up, we say bullish. Bear, basically bear. What bear does is when it attacks a person, it basically punches him down. It actually hits him down. This is how bear attacks. And that is why when the stock continuously is battered down, it is called bearish movement. Ravi, I will come to your question at the Q&A session. Okay, please pack it. Sure. And sideways is when the stock is not giving a clear-cut momentum, that it is going up, coming down, going up, coming down. If that is the movement, then it becomes sideways. So what you have to do is, when it is sideways, that neither it is going up, neither it is coming down, always wait. Because not just knowing when to enter into the market, it is more important when to stay away from the market. So when the market is range bound, it is not going either up or either down, you would stay away from the market. But if the market is going up, if the stock price of a company is consistently going up, it is in a bullish trend, then what you need to look at is the price at a support. That is, if the price is just fallen, it is a support and is now ready to bounce back. If yes, then you should buy. And once it has gone up, if it is at resistance, what you should do is you should sell. That is what the basics of trading is. That when price is going and touching the support, you should buy. When the price is testing resistance, you should sell. That is the basic. Now, reading this price and volume action is the real art. There are thousands and lakhs of people doing technical analysis. Everyone is reading the same chart. Now, what makes difference between one analyst to another analyst is not just price and volume action. There are certain things called emotions. There are emotions at play. In market, emotions are the real differentiators. People who actually have a control on their emotions become successful traders. And that is why I've seen many people with strong technical analysis background, strong understanding of market, but still they lose money only because they can't control their emotions. They know that this is not the right time to enter into the market, but still they get the urge, chalo kuch to karenge. They don't control the emotions and then enter into the market and burn their hands. Second, ego. You see a chart, you determine that, okay, this is a good stock, you enter into it, and then the stock is falling down. But since you said that no, this is a good price, it will go up. So you refuse to accept that though the price is falling down, you refuse to accept that you made a wrong call. So your ego doesn't allow. And that is what happens. Fear, greed, and ego. These are the three emotions which actually kill an investor or a trader. So at the end of the day, what is the risk? What is the risk in the stock market? Warren Buffett says risk comes from not knowing what you are doing into the market. So if you are not knowing whether you are investing, whether you are trading, whether you are doing the right thing, whether you are doing the wrong thing, then you are at a wrong place. Then stock market is not meant to you. So risk is coming from not knowing what you are doing. Ravi, explaining support and resistance in detail would take long time. I will try to do it during the Q&A session. And I'm a fundamental analyst and not a technical analyst. I have learned technical analysis, but I'm not a technical analyst. I'm basically a fundamental analyst. I'm a core investor. I believe in value investing. But anyway, during the question and answer section, I will take you through the basics of technical analysis. Okay, I will try to show you that what support and resistance mean in the chart. We will draw a chart and I will show you. Okay, I will take that into Q&A. So what you should be avoiding to do into the stock market and what you should be doing currently into the stock market. You forget about what is written into the slide, leave it, focus on what I'm telling you now. So one thing, market is at an all-time high level. It is at 60,000 levels. What is the next into the market, whether it will go up, whether the crash is imminent, whether there is a big fall that is coming up? Frankly speaking, no one knows. No one knows when the market is going to fall. And no one has ever known when the market will fall. No one knows. Only thing is, when the market falls, are you prepared to handle that fall or not? That is the question. And that is where you can prepare yourself. There's a very old saying, hope for the best, but prepare for the worst. So it is that preparation that you need to do at the current market levels. So if you are invested into stock market directly, what you need to do is check if the companies where you are invested are fundamentally very strong and have got good future growth prospects. If the company is fundamentally strong and if it has a good future growth prospects, then don't worry, you can keep your money straight invested into that company, because even if market falls, still ultimately your stock will go up as soon as the market recovers, because you have put your money into a strong company. But if the company is not fundamentally strong, you should book your profits now, because currently even Gadha or Ghoda, that is a horse and a donkey, both are being valued at the same levels into the stock market. So this is the time, if you have put your money into a bad company or not fundamentally so strong company, sell it, come out, park your money into some debt funds. Park your money into some debt funds and don't immediately invest into the stock market. Keep some money into a debt fund. Why I'm saying keep some money into the debt fund is you don't know whether the stock market will give you a fallen opportunity in next 6 months, next 1 year, 2 years, or it may be even 3 years. No one knows. But whenever this opportunity comes, to encash the opportunity, what is the thing that you need to have? Like March 20, when the market fell, very few people could actually take advantage of that opportunity. Tell me why. Why people fail to take the opportunity when the market falls? Panic ultimately creates. People start panicking. But even if someone want to take an advantage, yes, Piyush, available cash. Most of the time, people have already invested into the market. They had 10 lakhs, all 10 lakhs they have put into the market, and suddenly they see the 10 lakhs going to 5 lakhs or 6 lakhs. They're already into panic. They don't have any more money to invest. But if I say I have out of 10 lakhs, I have invested only 6 lakhs into the market. The 6 became 3. Yes, it became 3. I lost 3. But what I see is my stocks are good, fundamentally very strong. It's a one-time opportunity. Let me invest another 4. I will invest another 4, make it 7, and wait. But for that, I need to have some cash in hand. And this is called portfolio sizing. That you should have proper portfolio sizing. That how much of your portfolio should be into debt, how much of your portfolio should be in equity, and maintain this portfolio balance. So people who are saying that, yes, boss, I'm at 20, I'm at 30, why should I put my money into debt? No, boss, you need not put your entire money into debt, but at least some part. Some part, keep it into debt. And what is the actually yardstick? There is a scientific yardstick. Though I slightly differ from it, but what is that yardstick is? Say your age is 30. Then if your age is 30, then 30% of your entire money should be into debt, and 70% of the money you can put into risky things like stock market or land. But 30% should be into safe assets like gold, fixed deposits, debt funds. Similarly, if my age is 40, it should be 40% into debt and 60% into equity and other risky assets. So what you should do is always keep every year, once in a year, review that what is your total portfolio, and out of total portfolio, how much is into safe assets, how much is into risky assets, and see whether the portfolio is balanced or not. Am I making sense? Are you able to understand what I said about debt and equity and how you should balance your portfolio? Yeah. So what I would suggest is current opportunity, 2 things you do. See whether you are invested into good stocks or not. If not, liquidate your stocks. Second, see whether your total investment is tilted towards debt or tilted towards equity. Like if you're 80% into debt because of the fear that there will be crash, then again you're doing a denting to yourself. You should be taking risk. Keeping out of the market is not the answer. So last, I want to end this session by you answering yourself and start answering into the chat window these 4 questions. First, you already answered, but still reaffirm yourself that whether you want to be an investor, whether you want to be a trader, or whether you want to be both. I presume none of you want to be a gambler, at least after this session. You will not gamble anymore into the stock market. And if you feel you don't have the time, effort, and energy, or you don't have that zeal to put that kind of effort in learning this fundamental and technical analysis and learning about stock market, then what is the best thing to be into the stock market? What is the best avenue? What is the best mode? Tell me. Yes, mutual funds. Stick to mutual funds. And people who want to learn investing into the mutual funds, please attend my session on 12th November. And please inform any of your friends who want to invest or who are willing to learn about mutual funds. Please inform them to attend the session, provided you really like the session today. Okay. Second is, if you want to invest, because many of you are new to the stock market. So if you are new to the stock market, just ask yourself this question. Don't answer immediately, just think on it. That what is your biggest fear of putting your money into the stock market? Is it your fear that I may lose all my money? Is that fear, boss, it's too much of stress? What is your biggest fear? Identify the biggest fear which you have into the stock market, and then don't avoid getting into the stock market. See how you can address that fear. And this is where the third question comes, that if your fear comes true, what would you do? Will you stop trying again? No, trying again is not the option. Not trying again is not the option. What you should look at is why the fear is. What is the root cause? And most of the time, the root cause of a fear is ignorance. You not knowing about it will always cause fear. If I know how to drive a car, I will not have a fear. But when I don't know how to drive a car, when I hold the wheel and press the accelerator, my heart will start pumping, isn't it? But when I know how to drive this car, will I be fearful? Never. That is what fear comes from: ignorance. Fear comes from not knowing how to do, what to do, and when to do. So, last, pick up a stock market mentor of yours. And when you're picking a mentor for yours, ask yourself, what is it that you are expecting from the stock market mentor? Now, there are a lot of people into the stock market, like even YouTube. There are two guys. One thing is Rachna Ranade. Second is Phenology. I just forgot that person's name. Sorry, it's not kicking. But Phenology channel is there. And then there is third, which is my favorite. I really love that guy, Ishmael, is SOIC. That is School of Intrinsic Compounding. SOIC. So these are the three areas where you can go learn. A lot of free stuff of theirs is available on YouTube. Go learn from them. Don't worry. And if it interests, then you go for a paid courses. Okay. And if you want to do technical analysis, people who want to do trading, this guy called Abhishek, I forgot his channel, YouTube channel name. Abhishek, he speaks very well about the insights of the stock market. And then one more school is there of trading. I just forgot. I will put it into the group. So with this, I would request you all that if you really like the session and if you want to be connected with me in future, please join our Moving Towards Happiness WhatsApp group. It's a WhatsApp community where not just finance, parenting, health, there are all those experts who are there in the group, and you can ask any of your questions. So with regard to personal finance or tax, I'm there into this group. So any of your queries, any information you require, I am there in the group and I would be responding to your queries into the group. So I request you all to please kindly join this WhatsApp group. And if you really like this session today, I request please take 1 minute of yours for me. Go to MYSWISH Facebook page and please post your review. And if any one of you want to get connected with me, you can get connected with me on Insta or LinkedIn. And at both the places, I'm available in the name of RJ FinTalks. R for Rajesh, J for Jain, FinTalks, Financial Talks, RJ FinTalks. So guys, the floor is open for question and answer session. And if any one of you want to give any feedback live in the session today, like how you felt the session was today, you are free to share.
Yeah, first of all, thanks, RJ. So I joined a bit late, but though I was able to correlate the things you were talking, because I've been already into the stock market. And yeah, so I have a bit of questions. So when can we look towards the dividend paying stocks? I mean, there are certain stocks which pay high dividends.
Yeah. So when you are investing into stocks which are paying high dividends, okay, and if the dividend yield is more than 5%, 4 to 5%, if you see, you should be investing into that companies, provided you don't invest more than 20 to 25% of your portfolio into such companies. Because remember, only those companies which don't have high growth prospects, they will pay dividends. Because why a company pay dividend? Understand the fundamental. Why a company pay dividend? Say if I have earned 10 crores this year. Now, if I have got an expansion plans where I need another 40-50 crores. What I will do with this 10 crores? I will reinvest into the company. Am I right? But if I don't have any major expansion plans, I don't know what to do with this 10 crores. What I will do? I will pay dividend. So basically, high dividend paying companies are companies which don't have much growth prospects. There can be few exceptions, but basically, this is what the yardstick is. So don't invest more than 20 to 25% of your entire portfolio into this kind of high dividend paying companies. And what you should do is dividend yield. What is the dividend yield ratio? That is, if you are investing 100, if you are getting at least 4 to 5 rupees dividend, then you should invest into the company. Clear?
Yep. But usually some companies announce the dividend date, and then people start buying, and after the dividend is credited, I think again they start selling, right? So is that the common practice?
I don't basically subscribe to this kind of philosophy. I don't basically, because it is again trying to identify that minor opportunity. Because see, everyone in the stock market is smart here. None of us are dumb, really, frankly. Everyone into the stock market are quite smart people. Everyone knows that this is what happens in the stock market, isn't it?
Yep.
When so many smart people are there, tell me, why would one leave an opportunity to others?
Right.
Yeah. So it is actually very high time consuming kind of game.
Yep.
I would basically, Ravi, it seems that you are more of an trader kind of background, isn't it? You have more inclination towards trader.
I am an investor. Perhaps I would wish to be a trader. So
yeah. So here, people who want are still confused whether they should be investor or trader. There is one way that I would say that emotionally you can check yourself. How many of you are interested to do that emotional check? How many of you are interested to the emotional check? Whether you are more emotionally built up, your wiring is more for a trader, or your wiring is more for a investor. Yeah. So basically understand the psychology, how it plays, and what are the emotional kind of things that you need to have when you are an investor or a trader. So what does an investor needs? An investor needs a lot of patience, isn't it? Because it's a long-term game. You need to wait a lot. Patience. Second, you need to look what is there in future. You need to look a lot of like future, like trying to analyze things and then look at the future. Now, what you need to do is whenever you are doing any decisions, forget about stock market, in life generally, whenever you take any decisions, what kind of decision maker you are? Do you like to see pros and cons and you look by what will happen 3 years down the line, 5 years down, like you have got this far-sighted approach. You always look if I do something today, what would be the consequences of it in 4 or 5 years later? If you see that, and when you are waiting for something, like you are hungry and you are waiting for food, you want to go out, you are waiting for the cab. When you are waiting, how do you emotionally feel? Is it really very stressful for you to wait, or you are patiently okay? Yeah, it is saying 6 minutes. Let me figure out what to do for the next 6 minutes. You come home, you are really hungry. Your wife says, your mom says, it will take another 10 minutes, and you start shouting at them or this thing. I'm really hungry. What it is? Or you say, okay, 10 minutes. No, let me fresh up. Let me do something. Let me do. Are you cool? What kind of person you are? Try to observe yourself. Because for an investor, patience, long-term patience, waiting for it, wait. That is what is required. Second, you should look far-sighted. That today it is X, tomorrow can it be Y, tomorrow can it be Z. That is what we need to look. You need to see the future consequences. Okay. This is for an investor. Now for a trader. Trader, what happens is you are into the market. You come with a conviction that today I'm going to buy ITC at say 300 rupees price, and I'm very sure it will go at 320, and suddenly you see 300 becoming 202, 303 and 303, you make an entry into the market. It becomes 304, 305, 306. You say, see, I was very right. And suddenly you see it falling down. 306 become 308, 310. Sorry, 306 become 34, 35. It comes down to 290, and you start panicking. And you don't understand what to do. Should I move out? Should I cut down my losses? Or keep on praying God? God, I have invested money today. Please take ITC. God, what should I do? It is in that moment, how you hold your now, how you are quick in taking that decision, that will determine whether you will become a successful trader or not. So, how do you handle stressful situations in your life? For a trader, understanding his own psychology, that when things go south, when things become odd, how he handles himself, how he has ability to control emotions, that is very important, very important, because for an investor is playing long-term game, so stress is not much. It is more of analysis, conviction, and patience. It is like a Buddha. So it is like playing test and playing 2020. So if you're a test batsman, what kind of thing you need to have? You need to have a strong technique, patience, wait for the right ball, isn't it? T20, if you're playing, what you need to have? You need to have that ability to take risk, hit the big shot, and when suddenly things are falling around, keep yourself cool down, keep yourself cool, like our cool man, Mr. Dhoni, and keep on playing, sticking to your plan. I hope I'm clear now. That emotionally, how you should be checking yourself, that whether you are suited to be an investor or whether you are suited to be a trader. Because then your skill set, your emotions play a larger role. Emotions are the real differentiator between a successful and an unsuccessful person into the stock market. Sandeep has asked me how to reduce stocks diversification. Now, Sandeep, the best way to diversification into the stock market is ensure that you don't pick up stocks from more than 3 to 4 industry. Pick up stocks only with related to 3 to 4 industry, which you really understand. That if you are picking stocks from pharma industry, you should have ability to understand pharma industry. If you are picking stocks from chemical industry, you should have ability to understand chemical industry. If you are picking stocks from IT, you should have the ability to understand IT industry. So first, number of industries that you are investing into should be limited between 3 to 4. Minimum 2, maximum 4. Don't go beyond 4. Even a best analyst cannot analyze more than 4 to 5 industries at a go. Okay, that is the first. Second, ensure that the number of stocks that you are invested are between 10 to 15. Max 20. 20 is really upper limit, but 10 to 15, that's what. So if you want to buy a new stock, say you put yourself as a 15 is the upper limit. If you want to buy a new stock, 16 stock will go and 1 will go out. So totally it again becomes 50. Again, you want to buy one more new stock. You need to see first which stock to remove. Remove the stock, one more come in. So that 15 should be an upper limit. Now, third point of diversification is don't put more than 10% of your portfolio into any single stock. Only in exceptional scenario where you are very conviction, you are highly conviction that boss, this is a sure shot stock. I have very 100% confidence. Don't go beyond 15%. Am I clear about diversification?
Yes, Raj. Thank you.
Anyone else? Any more doubts?
Ajay, Ravi here again. You mentioned that you would show some glimpse around this support.
Yeah, Ravi. So this is ITC's chart. See the trend. What I will do is I will connect the bottom and I see. So here, if I'm connecting it, it is coming to 167. So if you see ITC is when it is coming down, somewhere it is hitting at 167 and there is a resistance here. So 160, sorry, support here. So this is the support. That is when the stock falls, it is not going to go beyond, yeah. So around 170, 167, it is actually 167. I actually hold up it. Yeah. So 167 becomes a support. That is when the stock comes around 167, I would look at entering into ITC. That is a long-term chart. If I'm seeing a short-term chart, I will just see a short-term chart. For the year, again here, I'm actually picking up again from here. This is the bottom. You need to connect to the bottoms and pull it here. So in short term, 180 is the support. In a long term, 167 is the support. So that is when the stock is falling down, if I'm seeing in the long term, at 167, it is hitting at 167, it is again going back. In the short term, that is in 2020, since 2020, when I'm seeing the stock falling down, it is holding at 180 level. The next support is at 180 level. And so any price range between 180 to 167 would be the price where I would think of entering at in ITC. Now, if I'm seeing resistance is when the stock is going up. When the stock is going up. So what you need to see is pick the top, where the top is. 2, 3, and the latest top. So these are the tops. You need to connect the top. So now ITC is exactly, if you see the current point of ITC, it is exactly at resistance. So if ITC goes above 250, I would wait. So currently, I would wait and watch for ITC. See what is the breakout it gives. This is not the time to enter into ITC. I will wait and watch for ITC. If it hits below 257, then the next resistance is somewhere around 275. So I'll wait and watch for ITC. So currently, I would wait and see ITC whether it is going up or going down from this current level. And if it hits go beyond 275, then I will enter. Or if it go below 180, I will enter. And ultra short term, if I'm an ultra short term trader, somewhere around 200. So this is how you need to actually look into technical. So it all depends on what is your investment horizon, trading horizon, whether you are a day trader, whether you are a swing trader, or whether you are a positional trader. So based on that, you look at different charts. And this is what you will learn when you go for a technical analysis sessions. Am I clear, Ravi?
Yes. Thanks for that.
Yeah. If there are no further doubts, we will end the session. I request once again you all to please join the WhatsApp group. Thank you all.